Coming up on today's show. Welcome everybody to the Daily Recap Show where we talk about stocks and the financial markets. My name is Chase. If you like this video, please subscribe, hit that notification bell as well as the like button and leave a comment for the algorithm. Let's get into it. This is the daily heat map of the S&P 500 and US stocks reversed early gains as cautious investors weighed new economic data in the midst of Nvidia's big artificial intelligence plans. And guys, the S&P 500 fell today, so too did the Nasdaq and the Dow Jones. And that was coming off some very upbeat action after the Consumer Electronics Show. But Nvidia and the big boys, the Magnificent Seven, led the selling. Nvidia was down 5%, AVGO was down 2.18%, AMD down 1.4%. But then you actually look at equipment manufacturers here for semis, as well as the broader semiconductor industry, they were actually green in light of everything. And we're going to speak about why. Software was red, except for Uber, which seems to be outperforming on a $1.5 billion stock buyback. The management team believe their stock is undervalued, so they're buying back their shares. Microsoft and Apple fell in excess of 1.3% each. Amazon and Tesla were a dumpster fire, and this meant discretionary is one of the worst performing sectors for the day. Meta was down 2%, Google down 0.6%. However, financials were very green across the board, except for asset management. That was red, but green across the board. Same thing here with healthcare. Energy was very green as well. And then we had mixed price action in a couple of the other sectors. Now, all in all, there were only two green sectors here today, energy and healthcare. That was pretty much it. Energy up 1%, healthcare up 0.36%. Every other sector was green. The SPY returned negative 1.24%. Now the market is still open, so this may change, guys. And the worst performing sectors being XLY and XLK, both down 2%. And that's why the markets were a bit of a bloodbath today, because when tech and discretionary is down this big, along with XLC being the third worst performing sector here today, it's going to be a pretty ugly day in the market. And that's because when you look at it in aggregate, large cap growth and mid cap growth, right? This is where like these big growth, high mega cap name stocks like sit, they were down 1.47, 1.97%. Very ugly day. The only green factor here was large cap value. And again, that has to do with like the energy and healthcare space. That's why they were up 0.16%. But, core, mid-cap core value across the board, very ugly. Small cap growth also, like that's a very ugly day, as well as small cap core down nearly 1%. Very brutal day across the board. Now, the reason why we fell today had to do with economic data, and economic data came in a little bit better than expected. Now, the ISM manufacturing PMIs showed that the sector actually expanded last month with a sharp rise in prices. You have a look here, services PMI came in better than expected. However, prices paid came in a lot better than expected, and this was the highest prices paid in nearly 2 years. And this spike signals persistent inflation, with economists warning it could keep core PCE elevated 3.5% through mid next year. That's 2026, guys. Today's data was a reminder that the Fed's battle against inflation isn't over, especially as tariffs and immigration policies may add price pressures in 2025. So yes, don't get me wrong, the economic data was better than expected. However, because of what it means for the inflationary picture, the market just didn't like that at all. Further adding on to that, we also got JOLTS data. And the JOLTS report revealed a rise in jobs openings, fewer hires against last month, and a drop in the quits rate. Now, the reason why a drop in the quits rate is not that great is because it's a signal of employee confidence to go out and find another job. And that indicates cautious worker sentiment if the quits rate is falling. In other words, less workers are quitting their job because they're less confident in finding a new one if they leave their current job. Now, the overall labor market is holding strong, and the jobs data today I wouldn't say was bad. It was just kind of mixed. I think a lot of people were looking at the quits rate more than anything else. In fact, jobs openings increasing a little bit isn't actually necessarily a bad thing. It's just that fewer hires probably pertains to a weaker non-farms at the end of the week. On the back of all of this, rate cut expectations didn't really change. We did see yields rise a little bit. However, we're still looking like we're going to hold this month here in January. Another big market mover today was actually CES, particularly Nvidia, Jensen Huang's speech. Now, we were actually very upbeat into the CES press conference. This is pre-market right here, and you could see that there, Nvidia was very upbeat, up as much as 1% during the CES speech. But after the day took hold, we actually saw Nvidia fall 5.35%, and that's probably because as volume came into the ticker, the street wasn't like super excited with what they heard. Jensen Huang gave a flurry of updates on the upcoming Nvidia products and a preview what's next in the burgeoning artificial intelligence market, but he mostly gave updates with regards to the consumer side of Nvidia, so mostly like the RTX GPUs that consumers use. But one thing I did take away from CES is that we are going to need a lot of RAM, high bandwidth memory, and that's why Micron in the semiconductor industry was up 3%. Actually, that's one thing you can take away from CES is that RAM chip stocks are probably next. Buying Micron here at 10 times forward PE is probably a great bet if you want to get like the leader in the space. Nvidia also announced that its main supplier will be Micron for high bandwidth memory. Other news not relating to CES, Palantir was down 7.49% on the back of a downgrade from Morgan Stanley. They raised the company's rating to underweight with a price target of $60. That implies 15 to 20% downside from where we currently are. And then we also had some news here in the healthcare space. Vaccine makers, stuff like Moderna, Pfizer, and other healthcare stocks gained significantly because we had the first bird flu reported death in the US, as well as an uptick in COVID-19 cases. As a result, healthcare stocks rallied. And for everything we saw today, very ugly price action, we continue to hold these very long-term moving averages, but everything from the 5-day to the 100-day continue to remain weak across the board. So if you're a longer term investor, you're looking at this as an opportunity to get long for 2025 and beyond, because these metrics continue to hold up. However, shorter term metrics do indicate some instability in the market. Net, we did see ugly breath today. 4,300 decliners against 2,100 advances. And a lot of the decliners we saw here in the market also was just like the Magnificent Seven names. And that's why we saw some pretty ugly price action across the equity spectrum today. Look at large caps down 1.19%. Same with the NASDAQ 100. The IWM down in excess of 1%. The outperformer here was actually the RSP down 0.48%. And that's because the broader market, stuff like financials and healthcare under the hood, really holding up the broader market as we do see declines on the back of the economic data. We have sentiment shifts and the CES, the Consumer Electronics Show. But a very ugly day for equities, all things considered. And if we actually go here to yields, look at 2-year, 10-year, and 30-year yield. They rose, and that was on the back of the economic data. The economic data was stronger than expected, and when that happens, you see yields rise. The dollar gained as a result, and again, that has an outsized impact on equities as a whole. Stronger dollar and stronger yields mean that the cost of capital is higher. Bonds are competition for equities, and a stronger dollar is not good for multinational corporations. Bonds fell as a result, and then we also did see a little bit of hedging here in metals. Gold and silver were up 0.5%, 0.3% respectively. WTI was up 1.15%. Nat gas fell 7%, crazy. And then we actually saw Bitcoin, a barometer for risk sentiment, fell nearly 6% here today. Guys, the market is still open, so we only close in about 10 or so minutes. And what we saw today was, we went from positive gamma here in the S&P 500 back into negative gamma. Now, the game plan this week for the S&P 500 was for us to retake the gamma flip zone and then consolidate here. So we're getting a little bit more volatility. Nonetheless, we can actually still hold here at this put support zone. So, things looking largely constructive as long as we hold this level right here, which is the low from December. As long as we don't break this in the first quarter, things looking very good. And this continues to be a very, very strong support zone where resistance right turned now into support on multiple occasions and looking like it's going to support the market right here as well. However, we do run the risk where we slip below here and actually have a close below that level. We could actually see downside price action to go ahead and close the Trump election gap up. Nonetheless, we are in negative gamma, and that means we can definitely make our way to the lower end of the put support or the put wall before moving higher. Nonetheless, this has held as a very strong support zone and do expect that to continue. The Nasdaq 100 down 2%, a bit of a dumpster fire. The exact same thing like the S&P 500, the put support zone holding this level right here. Do expect much of the same. Now the RTY down 1.19% today. And again, you know, all of these indices are doing roughly the same thing between the gamma flip and the put support. Now, we did actually see resistance here at the gamma flip. The RTY, the Russell 2000, couldn't make a close in positive gamma. And this probably means we are going to trade lower to the put support zone. But again, you know, we've held this level on multiple occasions. Resistance turned into support. I don't expect it to break unless the non-farms is a complete disaster, an absolute disaster. And to be honest, the labor market data we actually got today wasn't necessarily bad. It was very, very mixed. I think we need to look to the ADP numbers. If we can get a good print from the ADP numbers, I think we'll reverse a lot of the sentiment we saw here today. But, you know, all of this was just on the back of stronger than expected economic data. And that's why yields rose. As investors try to assess the inflation impact this will have on stocks and the market moving forward. All in all, I'm still a proponent of finding a dip buying opportunity in Q1 here. And for the S&P 500, if we go ahead and break right through here, we slip through the zone and go lower, this could be our opportunity to get long for the first quarter. But if this level continues to hold, then this is probably the zone to buy. So right now, we're looking at two things for the S&P 500. Will this level hold? If yes, this is the dip we want to buy for Q1. If not, and we break this level, we then want to look for very key support levels, which we'll get to. But what we really want to see first is a close below the 58.60 level. If we get a close below the 58.60 level and the put wall moves down, right, to a lower level, then we will be looking for a lower zone to buy. However, as it is right now, the buy zone for Q1 is 58.60. That can change at any minute. I reserve the right to change that. However, this is looking very constructive if you ask me in the S&P 500, the Nasdaq 100, and also the Russell 2000. It does look like the put support zones have been holding. However, if we do break those zones, things can get ugly very, very quickly. So scale into positions and keep capital ready. We did have a very ugly day today. This is a brutal day in price action, and it all had to do with a little bit of an inflation scare on the back of the ISM prices paid numbers. However, we will continue to get manufacturing data as well as labor market data throughout this week. And if we get better than expected data that pertains well to the inflation picture, expect a lot of this to reverse and expect volatility. And that's generally what we get in the first quarter of a post-election year. I talk about seasonality in today's video, especially in a post-election year, and do expect volatility in this Q1 in the first quarter. And that's exactly what we're seeing right now. So embrace the volatility. It's the price we pay for outsized returns in equities. Take advantage of the names and ETFs that you like and simply buy the dip, guys, because we will go higher into the year, especially into Q2, Q3, and Q4. And diving into sentiment, guys, this is the weekly community poll, something we do every single week on this channel. So go ahead and subscribe so you see these in your feed during the weekend. And guys, we have seen an immense change here in bullish sentiment. This was very close to the 50% mark just last week. We're now looking at the 60% mark. So we've seen a huge uptick in bullish sentiment. And then on the weekend, and investors in this community are feeling very bullish about stocks in the next week. And guys, bullish sentiment has this like self-fulfilling prophecy where bullish sentiment leads to higher prices and higher prices leads to bullish sentiment. And so goes the market until we have an exogenous event that can derail the market. That normally comes in the form of a policy mistake or error, whether it be fiscal or monetary or something along those lines. The economic data weakens. Nonetheless, we're not really seeing that right now. However, non-farms at the end of this week can derail that market. But looking at seasonals, something that's very, very positive is the first 5 days of January. Now, this is a crazy stat, guys. The first 5 days of January is a great barometer for bullish market momentum. And you can see we are looking very bullish right now, sitting at a 1.59% total return. And when we have the first 5 days in January here bullish, average returns tend to be 18.67%, but the median returns are probably the more likely with 15.63%. Nonetheless, you're looking at mid to high teens appreciation in the S&P 500 if the first 5 days are positive, and we're going to have to see a pretty big sell down here in the last 2 days of this seasonal barometer to take this into negative territory. It can happen, don't get me wrong, but highly unlikely unless something fundamental is to change in a very dramatic way. Non-farms could do that, but we'll see how it all pans out. Nonetheless, whether we get a sell-off or a rally, you kind of want to buy the dip here in the first quarter during a post-election cycle, because normally what we see is we do see ebbs and flows in the overall market. However, you want to look for an opportunity to get long. That dip can be at the start of the year, near February or March, or even into April. You want to sort of buy the dip for the rest of the year, because once we leave April, we kind of see higher highs, higher lows, with the S&P 500 in a post-election year having an average return of about 8.7%. Very, very good, especially considering the time-weighted average of this returns. We actually see 4 months of the year, nearly 30% of the year, where the market trades sideways, and then the final 8 months of the year, we actually get a blistering rally to the upside. Now, I did say that when it comes to breaking the market, there needs to be a massive exogenous event, and one of those events could be earnings. Right now, history suggests that 2025 earnings estimates have downside risk, and if earnings estimates and perceptions of earnings move down, so too will the market. And if we actually look at the median path, it's very likely that we will see continued downward revisions here into 2025. And we actually have seen that in the S&P 500. We've seen negative 2.7% downward revisions in aggregate. However, the big stocks, Nvidia, Alphabet, Amazon, Meta, Google, Broadcom, Tesla, have all seen very positive upward revisions for Q4 in the past 90 days, with only Microsoft and Apple letting us down, seeing negative 1.8 and 1.3% earnings downward revisions. And analysts' fundamental confidence in these names is a good sign, given that they represent over a third of the S&P 500 and therefore have an outsized impact on the index. I remain positive on US big tech, given their superior earnings momentum, guys. You see, look at the broad market versus these big names. It really goes to show the earnings power they have, and that is why I've always championed that kind of want to be long in these names in aggregate, or in at least 2 or 3 of these names in your portfolio, because they really are growing earnings and price tends to follow earnings growth. And diving into the macro, guys, again, with the exogenous events that could derail the market, we have seen downward revisions here for the fourth quarter in the Fed's GDP estimate, and this has come on the back of just like weaker than expected data in the last, I would say, 4 to 5 weeks. That's actually why the S&P 500 has traded sideways. Some of the economic data has come in not that great, and with valuations priced to perfection, we need nothing but positive data, and even inline data can see the market wobble. And you could see that we hit the 3.3% mark here in early December, and ever since then it's been a stair step down in fourth quarter GDP now revisions. And we've seen stuff like housing starts, import export prices, new home sales, personal income outlets, construction spending, and the ISM manufacturing data has all weakened the overall Q4 earnings outlook. However, when we look at other parts of the economy, they're looking very strong. This is absolutely insane. Federal employment tax receipts up 15.2% from the year prior in the month of January. Absolutely crazy stats when you look at it. This really goes to show the earnings power of the consumer. Disposable income and employee compensation are very strong in the past year. And going into the new year, expect more of the same, particularly with inflation continuing to decelerate. At the same time, the cost of credit insurance has been trending down. Fund managers have taken advantage of similar periods of cheapness in the past to build up insurance, but so far there hasn't been enough buying pressure to increase credit default swap risk premium. In other words, fund managers don't see the economy falling apart. They're not really buying insurance. Think about 2008. Why did you buy a credit default swap? Because you thought the economy was going to go in the tank because of the housing market. Fund managers aren't seeing that right now. They'd rather be long equities and risk assets over the insurance of that asset. and that bodes really, really well for the overall economy. At the same time, looking at the inflation picture, the 10-year break-even inflation rate, yes, we have seen an uptick, but ever since this high right here, or this peak right here, we've pretty much trended sideways as the 10-year yield has moved up and as equities and the whole market has rallied from the month of September. And again, break-even inflations are tamed. It really goes to show that fund managers aren't really worried about the inflation picture right now. Yes, we have had ebbs and flows, but net, we're kind of sitting where we were towards the start of October. And guys, the probability of a US recession in the next 1 year is sitting between the 15 to 20% mark. Just for the record, 20% is the long-run probability of a US recession. Goldman Sachs forecasts 15%, the market implied probability as about 17%. In other words, the likelihood of a recession is very, very unlikely and slim. Looking at earnings for the rest of the week, guys, tomorrow, Wednesday, we have Simply Good. That's about it. Jeffries as well. There's not really much tomorrow. And then diving into the overall data, on Wednesday, we don't really have much of anything, just the ADP employment rate change and then the MBA 30-year rate mortgage. But if you've made it up until here, thank you so much for watching. If you like this video, please subscribe, hit that notification bell as well as the like button, and leave a comment for the algorithm. Cheers.